All right, let's talk about January 30th. Because if you held any paper silver, we're talking SLV, PSLV, or treated the futures, that day was an absolute gut punch, a real portfolio shock. We're going to break down exactly what happened, not with feelings or stories, but with the cold, hard mechanics of the market. Okay, let's get right into it. But first, just the usual heads up. What we're doing here is analyzing market mechanics. This is not financial advice, so please, as always, do your own homework. Take a breath and ask one really important question. Because here's the twist, and this is really the whole story. You didn't watch silver crash. You watched one specific, highly leveraged corner of the silver market get hit by a massive forced liquidation wave. This wasn't a story about supply and demand changing overnight. No, this was about the market's plumbing breaking down under a whole lot of pressure. And this slide, this is Exhibit A. While your chart, the New York paper contract, was getting hammered down to $77, look at what else was happening. The London benchmark, the institutional price, still printed over 103. And in China, where they're actually buying the metal for factories, they were paying around $136. That's not a broken market, that's a fragmented one. So you have to get this concept in your head. Silver doesn't really have one price. It's better to think of it as a price vector. A whole bunch of different prices, all live, all for slightly different things. See, a paper contract can be sold instantly, with leverage in huge amounts. But a bid for physical metal, that's slower, it's stickier, and it's tied to real bars that have to be moved around. When stress hits, those two worlds can completely decouple. And this decoupling happens because you're really looking at three different markets. You've got New York, which is the paper hub. It's built for liquidity, which is great, until it's not. It's also built for forced selling. Then you have London. That's the institutional reference point, a benchmark price for settling big contracts. And then there's China, which I like to call the industrial sink. Their price isn't a bet on the future. It's a real bid from an economy that actually uses the stuff to make things. Now, normally, these markets don't drift this far apart. Why? Because there's a bridge between them called arbitrage. It's really just spread closing. Big trading desks see something cheap over here and expensive over there, so they buy the cheap one and sell the rich one until the gap closes. In the metals world, a really important part of this bridge is a process called EFP, exchange for physical. Just think of it as the mechanism that lets a trader swap a paper futures contract for a claim on the real thing. It's what keeps the two worlds connected. On January 30th, that bridge completely failed. The spread between the London benchmark and the New York paper price, it wasn't just a few pennies. It blew out to almost $18.50. When you see a gap like that, you have to stop thinking, oh no, silver is collapsing, and start thinking, okay, the connection broke. These charts are not describing the same reality anymore. So here's how the dominoes fell, step by step. First, a macro headline hits, a new Fed nomination that makes the market rethink interest rates. That causes the US dollar to spike hard. That dollar spike puts a ton of stress on leveraged trades, which triggers margin calls. And what happens on a margin call? Forced selling. And where does that selling hit first and hardest? The most liquid market there is, New York paper. Look, silver didn't sell off because someone discovered a brand new mine at 9:42 in the morning. It sold off because paper silver lives inside these huge leveraged portfolios. And this is the core of it. When volatility spikes like that, all those automated systems get the exact same instruction at the exact same time. Reduce risk right now. A margin call, it isn't a story, it's not an opinion, it's just math. Your collateral is no longer enough to cover your position, so the broker closes it for you, period. And here's a key amplifier. When volatility goes nuts, the exchanges themselves can jack up the margin requirements, so you can be forced to liquidate a position even if its price hasn't moved, just because the cost of holding it suddenly jumped. And then comes the second-order effect. The folks who are normally there to provide liquidity, the market makers, they do the smart thing and protect themselves. They pull their bids way back, they widen their spreads. All of a sudden, the order book gets incredibly thin, and the market becomes completely one-sided. That's how you get these absolutely violent price drops on what is sometimes surprisingly little volume. So, to sum it up, the arbitrage bridge doesn't fail because there's no silver left. It fails because the trade to close that gap just becomes too risky, too expensive for a bank's balance sheet, or frankly just too slow to execute in the middle of a chaotic liquidation. And when that bridge is down, the paper market can trade like a fire sale while the physical world stays anchored to a totally different reality. Okay, let's look at the receipts. Let's look at the actual data. First up, COMEX vault data. Now, if this crash was about everyone rushing to dump their physical metal, what would you expect? You'd expect deliverable inventory to surge, right? Well, instead, the registered inventory, that's the stuff that's ready for delivery, it actually fell by about 3.28 million ounces. That pretty much proves this wasn't driven by a mad dash to sell physical bars. Receipt number 2, the SLV ETF. It closed the day at a massive 19.33% discount to its net asset value. What that means is people were dumping the paper wrapper, the ETF shares, so fast that the arbitrage banks, the ones who were supposed to exchange shares for metal, they just got completely run over. A nearly 20% gap is a screaming, flashing red light on the dashboard, telling you the plumbing is seriously broken. And the third and simplest reset is right where we started. The prices just didn't line up. You had New York in a full-blown liquidation, while London and China were holding firm. This is the classic, textbook signature of a market that has fragmented into different pieces. So, okay, where do we go from here? If you're holding paper silver, the signals that tell you the market plumbing is getting fixed are purely mechanical. You don't need a new story or a new thesis. You just watch the gauges. Is the SLV discount to NAV starting to close? Is the New York price starting to catch back up to London? Are the wild daily price swings getting smaller? And maybe most importantly, is the dollar chilling out and stop delivering these shocks? This isn't about faith, it's about observation. So as we look forward, there are really 3 probable paths this can take. The base case, which I'd put at about a 65% chance, is simply repair. Volatility cools down, the arbitrage guys come back in, and the paper price reconnects upward toward physical. The 20% upside case, that's a squeeze where strong physical demand actually forces the paper market to chase it higher, and fast. And then you have the 15% downside case, which is a macro crush. A rising dollar forces even more liquidations, and that stress finally starts to bleed over into the physical side. So let's bring it all home. Here's your final takeaway, your pilot's checklist. Number 1, January 30th was a paper liquidation event, period. 2, the crash was driven by the dollar, by leverage, and by a lack of liquidity. 3, it was not about a sudden change in physical supply and demand. And so, number 4, the most important thing, watch the spreads. That means SLV versus its NAV, and New York versus London. They will tell you when the machine is fixed. Stay calm and watch your instruments.